Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Welcome to this very special episode of the podcast where we're going to tackle everything personal insurance related. And in this episode, we're joined by two experts, two qualified experts. James, how you going? Back on the show.
Hey, mate. Nice to see you.
Many of you will know James as, I don't know if you call yourself founder. Do you call yourself founder?
No, it's a bit wanky, isn't it?
Yeah. Well, I should take note of that then. Financial advisor of Northeast Wealth. We've got him here with us in the studio. And Phil Thompson from Skye. How you going?
Good. How are you?
Good. First time behind this mic, but people will be familiar with you from some of the other stuff you've done.
Yeah, I get out there and talk about insurance because no one else will.
Yeah, so we're going to do a kind of like a deep dive into the major types of insurance that relate to your personal situation rather than, say, general insurance or your car insurance. We're going to talk about life insurance. If you've heard of that, I sometimes call it death insurance, which is probably a bit glib, but it kind of makes sense. Income protection and these types of things. So this episode is going to be very comprehensive and we hope to not leave you behind. James is a financial planner dealing with basically everyone, but what he is going to do, I hope today for us, is give us kind of like the holistic picture of how insurance fits into someone's situation. And then Phil's here, he's going to get into the weeds on the really technical questions about like what happens behind the scenes, what happens in underwriting and these types of things. If you don't know what underwriting is, we'll cover that in a minute too. Maybe for those who don't know James, do you want to give us an overview of yourself and the business?
Yeah, sure. Financial advisory practice. Well, I'm a financial advisor, of course. We have a financial advisory practice in Melbourne. Our focus is on helping people to make more progress. It's really dialed in and intentionally we take a really broad scope with that. So we'll be looking at not just your investments, but all elements of how we can improve your financial situation, tax minimization, how we allocate funds moving forward, cash flow, your financial behaviors, and so on. So insurance forms a good part of that. Yeah, great. We've done some webinars and a course with you, which is all available on the Rask websites, which people can refer to as well. Phil, how about you? Your business is a little bit different. So can you explain maybe your background and then kind of the development of Skye and what you guys do today?
Yeah, so our business is similar. So we're financial advisors. So we're qualified exactly the same as someone like James, but we've chosen to specialize in insurance-only advice. So for a long time, for 8 years of my career owning the business, we were doing very similar work, holistic advice, looking at everything. And then we made the conscious decision to go in insurance-only. And we can talk about kind of the reasons why, but a lot of advisors are moving out of that space and looking at how do they carve out insurance advice out of their holistic process. And so we've decided to lean into that and only provide that advice.
Yeah, so someone would come to you and you would effectively, in like a discovery call or a first chat, your team would say, this is kind of like the scope of our advice. And so can you just maybe explain that then, just as like just to get a sense of it? So someone would come to you only for insurance if they wanted, say, advice on like investing or something like that. Even though you may talk about insurance from the perspective, you may talk about superannuation from the perspective of insurance, you're not really going to tinker with people's investments inside super.
That's right. Yeah. So we scope out the other pieces of advice. If a client does come to us and said, I'm looking at, my investment options or, considering moving superannuation, we'll just articulate that we're not the right fit because we won't offer that advice. Even though we're qualified, we're experienced to do it, we've chosen to only offer insurance-only advice. Mm-hmm. And the main reason being is because advice can be cost prohibitive for the masses. Mm-hmm. But insurance is a very important financial decision that people are paying thousands of dollars a year, and we want to be able to help that. So we've just lent into that only, and our advice fee is significantly cheaper because of it.
Yeah, right. And then that's where it's interesting with you, James, because you basically brought Phil and I together.
You're welcome, Phil.
And you were pretty adamant and keen for us to meet because I know a lot of what you do is like you said, you cover all of those other asset bases, you cover liabilities, you cover cash flow, like all of the other things you have to take into consideration. But then when it comes to insurance, how do you approach that with your business and your clients?
We also offer insurance, and it's a really important part of our offering. When you're looking at someone's entire financial life, insurance is part of that. But if I can be analogous, we think about the role of perhaps a general practitioner versus a cardiologist. If you went to a GP and said, okay, I'm having some issues with my heart, unless those issues are pretty straightforward, the GP is going to say, look, it's best for that particular element, for that particular thing should be addressed by someone who just specializes in that area, and that's why you go. So from our end, our members come to us and say, hey, we want that general practitioner. We want someone who's going to give us the guidance and leadership. We want someone who can confidently tell us how to get to where we want to go in our lives and achieve our financial goals. That's us. And we can do that very well. And again, insurance would form part of that overall discussion. But at a business level, the benefit of having someone like Phil is that if there's really complex insurance, similarly, then you can refer that. Mm-hmm. And then in the context of both of you for the relationship, what I said to you was that if you're having discussions about insurance with your member base, as far as I'm concerned, Phil's best in class. I know you really well, Phil. I regard what you do really highly, and I think it's a missed opportunity to not have someone who knows it as well as possible.
And I think, to that point, me and James, we run different businesses in different styles and we serve very different people. And I think as financial advisors, what we've seen as an evolution of the profession is that advisors are getting very good at knowing where we play and where we don't. And then where we don't play, we want to partner with other businesses who are going to be best suited. So when we get clients saying, hey, I want investment advice or I need assistance with superannuation, great. Well, I know 5 other advisors who will be a great fit for you based on kind of their needs and objectives.
So you mentioned before that we can talk a little bit about Skye. We've had breakfast the other day. It was great. Good to catch up.
Thanks for the invite, fellas.
You made it happen, so credit to you. Thank you. So can you tell us, so then if we are going down this route as an industry where more specialization comes in, and particularly with insurance where most people get out, as in more professionals get out, which makes it harder for the rest of us to get insurance. Why did you set up your business to focus only on insurance? It seems like counterintuitive, right?
Yeah, that's right. I mean, I'm very, very passionate about making sure that the everyday Australian can get advice. Now, the trend within advice, because of a whole bunch of factors, the advice landscape has been we need to go up and up the wealth scale to be able to serve these clients, because the cost to serve from an advisor's, and every advisor I talk to is not charging more because they want to make more money or be greedy. Most of it is because we need to stay in business and the cost to serve these clients is incredibly high. And so that's why it is becoming less and less accessible to the everyday individual. And I'm super passionate about that. I grew up in an average household, and I know insurance is one aspect that is super important. We spend so much money on it, and the ability within insurance-only advice is we do get paid a commission from the insurance provider to subsidise that cost to serve. And so that is why we're very comfortable going, hey, we'll charge you a small cost up front to give you advice, to give you value, and if you choose not to go ahead with it, then there's no other cost. But then we get paid a commission if the clients end up taking out the insurance.
Yeah, right. So I guess a question then is, and this is more like just broader, feel free to jump in, James. It's like, if I could go to, say, I don't even know if they do this, but I select Finder, one of those comparison websites, and I can see all the different types of insurance. Why would I go with, say, an advisor like Skye and your team versus, or even James, why would I do that versus, say, just going to the website and clicking a few buttons and whatever?
Yeah, so an iSelect or Finder, you can go on their website and you can look at the insurance options. Most of their options are like a Medibank, and Medibank, the actual underlying insurer is not Medibank.
Right.
They're not the life insurer. So I think maybe AIA or Zurich is their underlying insurer. There's actually only 2 insurers who will sell direct. Those other ones, those branded kind of insurance, the Medibanks, the real insurance, they're just have another underlying insurer. They're just like the distributor of that product. So there's only really two insurers who will have good quality products that they offer direct. Most, 70% of all insurance in Australia is set up via an advisor. So insurers want to work with the advisors because we are, considered distribution to them. And so there is this kind of, whether we like it or not, there is kind of this gatekeeping behind the advisor where good quality insurance products, the ability to structure those insurance products is much more flexible with an advisor. And that's because the insurance companies themselves, they don't own an advice license, or they're getting out of advice, providing advice, because there's this kind of vertical integration that's on its way out, which is good or bad. We can have a discussion around that. But that's why a lot of the products is actually not available going direct. Yeah, right. So going direct meaning that I'm not seeing an advisor, I would go direct to the website, sign up type of thing. Yeah, right.
Yeah. I think that, if I may add to that, another really, have you had the experience of going into a finder or a compare the market, and it's when you're in that line of work, you understand that insurance is actually really nuanced. To do it well, you can do it simply, but to do it well and to consider the fact that every insurance company actually has pretty significantly different offerings based on your own situation, based on your medical history, based on a whole heap of reasons. And my experience, I went through that process a little while ago to understand what do they do and trying to recognize maybe there are some efficiencies that we can consider. And I realized there are some efficiencies. You just don't do any of the deep stuff that you should be doing in order to give someone quality advice. You just glaze over that. You put a heap of disclaimers in and just say, hey, it's up to you to work these things out. It's up to you to work that out. Structuring can't help you there. Sums insured, we'll leave that to you. That was my experience.
Yeah. Well, and not even I can't help you. Insurance companies, when you go direct, they won't allow you to get your super fund to pay the premium. So it's not even just we won't help you pick you pick. It's they just won't allow that structuring. And to your point about that expertise, a great example is, family history of breast cancer. If someone's had their parent have cancer, that'll impact my cover, my application. One insurance company will just exclude breast cancer. One insurance company will load the premium, so charge more for that cover because of family history. It's not my experience. It's my parents. And another insurance company won't put any exclusions or loadings on the policy. So if I'm looking just straight at the premiums, looking at a finder and going, okay, how much is this going to cost me? I don't know what that underwriting outcome is, but an advisor will do that deep work, do that research, ask a whole bunch of medical questions up front.
That makes sense. Okay. So I'm hoping one of you can explain the idea of insurance, just generally speaking, maybe cover off on a few of the key terms that we're going to use. We've already used things like underwriting, premiums, these types of words. Some people will be familiar with them. Maybe there's a little bit of confusion. Maybe I'll start with you, Phil. If you want to go through just a high level, what is insurance and how do we kind of think about it?
Yeah, great. So there's really 4 types of policies when it comes to insurance. There's life insurance or death cover. So if you pass away, there's money that's paid out to your beneficiaries, your dependents, or to your estate. The next one is disability cover or TPD. And that means if you can never return to work again, then there's a lump sum payment that can be paid out. The third one is income protection or salary continuance, some insurance companies call it. And that is replacing a percentage of your income if you can't work. So there's normally a cap on that replacement of income. You can't get a full replacement of your income. It'll be a small percentage of it. And then the fourth one is trauma cover. So that's for critical illnesses. So things like cancers, heart attacks, strokes, MS, Parkinson's. There's 40 odd conditions that it'll pay out on, and they're very specific and very clear cut. If you are diagnosed with X, then you'll get paid out your claim.
Right. Okay. James, people are familiar with car insurance, maybe home insurance. A lot of the terms for those types of things seem pretty relevant to people. People know roughly what goes on in a process when you get car insurance. But maybe just for some of the key terms that you think about, can you maybe just define some of those, or even at a high level, some of the phrases that you use with clients?
Yeah, of course. And we talk about premiums often, and most people that will be familiar with any type of insurance would understand the premiums. That's the annual or the monthly amount that you need to pay in order to maintain that contract. And similar to if you think about a car insurer or a home insurer, what you have there when you sign up and start paying those premiums is you have a contract. So you have an agreement that you'll continue to offer me that level of protection if I continue to pay the premiums. And so your payment is acceptance of that contract, and then that will continue until, largely speaking, in most cases, until you stop paying the premium. And then, of course, that's when it would end. You mentioned before underwriting. Underwriting doesn't happen, certainly very rarely happens for cars or for homes. But underwriting in personal insurance is required because everyone's medical situation is different, and everyone's financial situation, everyone's occupation is different. Let's imagine that we had two individuals, for instance, who were looking for life insurance. One person is a roof tiler working at heights above 20 meters without any harnessing, and the other person works as a podcaster. Now, hopefully you're not doing too many hostile things on the weekend, mate, but I'm sure most people would look at that and say, well, ignoring pastimes and hobbies, it's likely that it's going to be more dangerous insuring a tiler that is doing that sort of work. Similarly, that we might have two individuals where one has this long history of poor health and family history and is overweight and so on, and then we've got someone who is the picture of good health and doing all the right things. Again, there's different levels of risk for that. And the last point is around financial underwriting, which is that you might have two business owners. One person consistently earns great income all the time, and the other person has a business that's losing money. And again, from an insurance perspective, that can impact how we look at them. So underwriting is designed to more often than not, it's a human who would make a decision, who would look at the case of the individual in front of them and say, okay, based on this individual, we're likely to treat the premiums like this, the terms of our contract would likely be like this.
And this is, coming back to underwriting. So car and home insurance, they are underwritten, but all the data that goes into the underwriting decision is all very publicly, listed. Like, what's the crime rate in the suburb that you're in? That'll increase your premiums for your car insurance. Are you locking up your car in a garage versus out the street? Like, those things are very much, you select a button, the computer will then, indicate what the underwriting decision is, which is a premium level. When it comes to each individual, we're all very special butterflies. Your mental health may be different to my mental health. And how do we know that? Well, we've got to fill out a whole bunch of questions about our mental health, And so, two people doing the same thing, same age, may have different outcomes when it comes to their insurance premiums. And that's why length of application, you go and get home insurance, you click a few buttons, you pay your premiums, it's straight away. When it comes to like life insurance and income protection, it's very labor intensive from the insurer's point of view because they want to know what risk they're taking on offering anyone a contract.
To add to that, I often get that objection, I'm sure you would at times, around the length and the level of detail that they're going into. But it needs to be considered that from the insurer's perspective, often the risk that they're taking is much greater than if they're insuring a car or insuring a home. It's not uncommon at all to be looking at life insurance to clear a mortgage. A lot of our members have mortgages above $1 million. And so, more often than not, that's higher than the build cost that you've got insured for your house right now. Not always. And similarly for a car, if you're rolling around in a car where the payout is more than $1 million, then hats off to you. That ain't me. So again, the risk to the insurer is, and the worst case scenario is actually far more significant, and hence the greater level.
And if I can geek out a little bit here, under the Life Insurance Act in legislation, the insurance company can't cancel that contract on you. Under the General Insurance Act, it's renewed every year. So if an insurer is struggling or says that this suburb, we don't want to insure people in this suburb, next year they can just say, actually, we're going to cancel these policies.
That was like the flood insurance from like the terms up in Queensland, I believe.
Yeah, exactly. Like under general insurance legislation, they can change the terms every year. They can change the conditions. Under a life insurance contract, they offer you cover once. It's guaranteed until you cancel your policy or stop paying the premiums or you pass away.
Interesting. I might just interrupt this flow and ask a personal question. Do you guys have all four of those insurance, Phil?
Yeah. A lot. I'm increasing it at the moment.
Right, James?
Yeah. It's a curious thing that most people, for example, with their cars, I meet very few people that don't have car insurance and don't have full comp. I think that perhaps you can recognize the immediacy of something going wrong. Right? What if I drove out of my driveway and I made a simple mistake and that was my car written off? Where would I find the 40 grand to buy a new car or plus their expenses? You can really easily make that connection. For life insurance, we sit down with a lot of people, and you would too, particularly younger people, respectfully, who it sort of hasn't entered their mind that you could have these costs. And perhaps in the back of your mind, you're thinking, I'd get help from the government and family and support. But our experience is that when those events happen, you need insurance for them in the same way that when those events happen, like the car getting totaled, you need full comp.
And I think you'd find very few financial advisors not having the full cover. Like, I asked lots of advisors who don't even do it anymore, who, kind of like, oh, this is expensive for my clients. And I go, well, what's your cover? How much have you got? Well, I got $500,000 of trauma. And I'm like, oh, okay, well, what about your clients?
Yeah. I have all of it, but I don't have trauma. So then you may have a new client soon, Phil, most likely. So I guess there's a big question that's on everyone's mind. Most people know that you can hold some type of insurance inside super. James, you did a webinar for us a little while ago with Kate, which was about cash flow and understanding, and there's a great Excel spreadsheet that people can access on our education side to map their cash flow versus their goals and so on and so forth. Can you talk to us about maybe the pros and cons from a financial planning perspective of using super as a vehicle for insurance?
Sure. Phil gave a great rundown before of the insurances that are available, and there are 4 insurances. There's life insurance, there's total and permanent disability, income protection, and trauma. The first 3 can typically be held through a superannuation fund, and trauma cover can never be held through a superannuation fund. And the thinking is simple. If you make a claim on a trauma cover policy, for example, due to a heart attack, then because the policy is held by the superannuation fund, then the payout actually goes straight to the superannuation fund. So we have this problem where you're not able to access the superannuation money. So I've suffered a heart attack, my super fund's $180,000 richer or whatever the amount is, and I can't get to it. Yeah. So that makes the whole thing redundant. Yeah. So with life insurance, total and permanent disability, and income protection, there's particularly for the front 2, as far as I'm concerned, there's some really significant benefits in putting those policies through superannuation. And the most obvious reason for that is that those 2 policies are typically not tax deductible to you. Or they're not tax deductible to you as an individual.
Right.
So if you want to pay those premiums out, let's say for simplicity, your life and total and permanent disability cover is $1,000 a year. If you want to pay them out of your own pocket, well, then you earn your income, and let's say for simplicity, you're getting 39% tax bracket or whatever. That's $1.80 that starts in employment income, which washes down to $1 in your pocket, and then you're using that dollar to pay the premiums. So $1,800 of your employment income has resulted in $1,000 of your money to pay this insurance policy.
So it's not as effective.
No. Now, conversely, if we put that money inside super, and you put that policy inside super, firstly, we do often get a tax deduction inside the super fund, which makes that cover in real terms cheaper immediately. But then also you can do what's called salary sacrifice. You can put money into super to pay for those premiums, but your tax rate's in a lot of cases only going to be 15% on the way in. So for all intents and purposes, you could perhaps put $1.20 into your super fund instead of the $1.80, and that would pay exactly the same premium. So that from a tax perspective, it often works out much better at the front end. And then, of course, the cash flow benefits for people of holding those policies inside superannuation and using your money for other things, paying mortgages. Obviously, we've got some significant challenges around the cost of everything at the moment. And so being able to tuck that cost away to superannuation is advantageous.
And for income protection, my understanding is because it's for income, that's effectively the test for tax deduction. And you can have that inside super or outside. I'm going to throw to you in a second for something about this. But.
Yeah, you're exactly right. So with income protection, broadly that is tax deductible to you. And so the advantage of that example I was using before of the $1.80 from your employee, which turns into the dollar of insurance premiums, well, Now it's $1.80, which essentially goes back into $1.80 because when you get your tax deduction for the policy, it works out. It reverses the effect of the tax being paid on that money in the first place.
Okay.
So income protection can definitely be much more advantageous to hold personally, and I feel I'd be keen. I'm sure you can speak to the difference in the quality of cover too, which is meaningful, and it becomes more meaningful if you, particularly for income protection versus life and total and permanent disability, in my experience.
Yeah. I remember being in the shower at footies one day. It was a freezing day. So
Where's this going?
Up in Olinda.
I know.
All the boys were asking, for some reason, all the boys were in the showers, and we just started talking about income protection and how,
of course,
how
standard
they,
conversation.
Because I think the previous week someone at footy had broke his leg, and he was a tradie, a chippy. So we're all like kind of freaked out, to be honest. And a lot of the guys had kids and single income households and that sort of stuff, and none of them knew that they could get income protection through super, and I didn't give them advice, of course, Asic.
Of course,
but I just said, that's an option as well. If you can't afford to pay it out of your own wage right now, there is another option. There are pros and cons, but there is another option. So James has given us a great rundown of kind of how super works from a perspective of like cash flow, tax, etc. Is there anything that you'd like to add there?
There was a good rundown. The only thing I would add is some of the income protection and TPD, which James kind of alluded to, is there are some limitations with holding it only within your super fund. So the limitation within super, and this is why trauma can't be held within super, is you cannot hold a policy within super and have your super fund pay for it if it can't exit the super fund on claim. So that's what happened in 2014, and the government made it a change to say there can't be any benefits going into that super fund at claim time. It can't be paid out. So it means for income protection, there are some really funny rules about like you need to be gainfully employed at the time you claim on it. So very unlikely to happen. But if you go on a holiday, 6 months, you quit your job and you go on a holiday, and when you return, you plan to get back to work. But when you're overseas, you injure yourself. You're not gainfully employed at that time. And so therefore, when you go and claim on your income protection, if it's held only inside a super, the insurance provider will say, well, you've got to meet this condition of release, which is gainful employment. We're not going to pay you anything on claim. So you could be paying your premiums for 10 years. So there are some contracts these days, and they're very new, where you can, through an advisor, you can have it all through your super fund, but a small portion of the premiums is paid outside of super just to capture any of those really funny clauses in the contract. The other one is TPD. So within superannuation, there are kind of two main forms of TPD, or total permanent disablement. One is based on can you do any occupation ever again? So the insurance company will make an assessment. Can you do any occupation we can reasonably expect you to do again based on your experience or your education? Yep. So if you've done heaps of stuff in your past, then maybe harder to claim on that. So for me, if I want to claim, or if I need to, not want to, I don't get to make the choice on claiming. If I need to claim on mental health, because being an advisor talking about death all day and helping clients with claims can be stressful. If I need to claim on it and I had an any occupation TPD, the insurance company can reasonably say I can work in a bakery because I did that when I was 14.
Yep.
And so, it is something to consider. It's not the most important thing because, you got to think about statistical likelihood of a claim and all these things. But the other option is own occupation. Can you do your own occupation again? So for me, if I needed to go on claim for mental health, then the insurance company can say, well, can you do your own occupation again based on this claim? The answer is probably no, I can't, because the job is talking about death, helping claims. And so that own occupation can only be paid outside of super. And so you can actually set up the policy where you can pay, 2/3 of the premiums inside of super. You get the tax deduction for that, and then 1/3 of the premiums outside of super. So they're kind of linked. You only ever get one payment, but if at claim time they'll assess, can you do any occupation? No. Okay, but you've got this own occupation feature. Okay, now we'll assess, can you do your own occupation?
So effectively someone's splitting the insurance inside and outside of super.
Yeah, you get the best of both worlds.
Yeah. That's actually, you raised a point. Can you claim two insurance Like if you had two lots of income protection, could you
Yeah,
claim
you
that?
can. Yeah. So something like income protection, as long as the maximum benefit isn't more than 70 or 75% of your pre-disability income, number one. Number two is some super funds will have like an offset feature where they'll say if you are, we'll insure you for $3,000 per month. And if you've got a $3,000 per month policy elsewhere, we'll fully offset it, even if your income was $500,000 before disability. So that's something that we look at is, okay, is the super fund do they have an offset feature? Which means we sometimes will double up the amount of cover because we know they both won't pay out.
Right.
Something like life insurance, if you've got $500,000 and you got 3 of those policies, they'll all pay out.
How about outside of super for income protection?
It's the same thing. You can get paid. So if my pre-disability income was $500,000 and I've got 2 policies worth $3,000 each, they can stack on top of each other. So they'll both pay out. Again, you got to triple check the conditions and the terms of the policy to make sure there's no offset. So you literally just Google the PDS and search offset because that's the normal term that they'll use. Most of them outside of super won't have an offset.
Okay. James, in your experience, as a financial advisor dealing with many clients, so pre-retirement, retirement, what role do you play, say, once someone has a policy in force? Do they come to you? Do clients ask you questions about claiming? Do you play a role in that at all?
Yeah, definitely.
Yeah.
Most of our members we're meeting pretty frequently, meet quarterly for all of our ongoing members, and so at least annually we'd be looking at their policies that are in force. And there's a few things that we're looking at. The first one is the fact that your insurance needs are changing over time. One of the most obvious ways that it would change is that hopefully over time your assets grow in value. Your net position, your financial position grows. And as a result, because you've got a lower mortgage, because the value of your super balance has grown and the value of your other investments have grown, your need for insurance over time is starting to fall. So proactively, we're looking at that, annually. For those that were unadvised, you'd still want to be doing that at least once every couple of years to just take stock of, do I have the right level of cover? Because I don't know how you feel, but a lot of times we might come across someone that took out cover 10 or 15 years ago, and we run the numbers and we think like you need half of this, which is a shame because the premiums are expensive and you'd save half on premiums. More often today, we're also looking at the terms with which they were given when the policy was taken out, because it's very common now to have exclusions placed on a policy or loadings placed on a policy. When I took out my insurance, to give you an example of of how insane it can be, when I took out my insurance, I just started running again, taking about 12 months off, and I thought I'll get back out there. And my right calf was feeling a little uncomfortable, just enough to go to the physio that was upstairs from the office. Like everything was that simple. And they excluded my right calf for total and permanent disability cover and income protection. And I pointed out that their argument was, hey, it happened very recently, only in the last few months, and it could blow up to be this horrible thing. And I was reminding them, like, I work a white collar role. Like, in what world would the severity of this expand to the point where I'm totally and permanently disabled? But their position was, no, you have an exclusion, and we'll only offer the cover with that exclusion.
Yeah, right.
So what we will be doing in that case is taking stock of people's exclusions or any terms they have on the policy, and then asking them about their current health, and then obviously liaising with the insurer to say, hey, can we get that lifted? Because in the past it might have been applicable, and very recently we had a member who had a mental health exclusion, which is a really crappy exclusion to have on your policy. If you can avoid it, you should. And we were able to argue with the insurer and get that one lifted based on the fact that when the policy was taken out, it was that those terms were reasonable, but it's been a couple of years now. He hasn't sought any treatment or had any symptoms, and so it's time to remove it.
Fair enough. I did have a question, but it completely slipped my mind. How about in the case of claim time? Do you ever work with clients? Like, do you support them in that regard?
Yeah. We would. I think most advisors that write the insurance, I'd like to think most of them would also support the members with the claim process. I had this happen just 2 weeks ago, one of our members, unfortunately, was diagnosed with prostate cancer over the summer.
Oh, right.
And we had our quarterly review, and amazingly, despite the fact that he's got the cover in force, you're smiling, I'm sure you're familiar with this, Phil. Amazingly, he completely missed the fact that we had a policy just for this purpose. And I think part of that just speaks to how much, like, the emotional toll and all of the things that you're going through, all of your thoughts when you're given that diagnosis. And we sat down together, and I said, Aaron, you've got insurance just for this. And at the time, and even now, presumably, he had pretty high expenses associated. He wanted to get the best level of cover that he could, and he went through the private health system, and there was quite a few costs associated. And it was a tremendous relief. It was a really emotional point for him for the meeting, for him to learn, okay, I've got a really significant amount of money that, all things being equal, based on your diagnosis, should get paid out. So in that case, we're straight away sending him through the claim forms, and we're pre-populating those as best we can. We're requesting the histopathological reports and all those key things that we would need to give to the insurer, notifying the insurer that there's a claim coming your way, and then we'll get all that stuff sent away to the insurer. My experience, and perhaps we've just had some good fortune with claims, my experience is that when you put it all together in one fell swoop and you send it away to the insurer, they're pretty good with getting it done.
So in this instance, is that trauma cover because it's prostate cancer?
Yeah, it is. The first and foremost, the trauma would pay out, of course, and we hope that there will be a really smooth recovery and everything will go really well. In a worst case scenario where that got to a point where you didn't meet a total and permanent disability definition or something else, well, then of course there'd be the opportunity to claim on other insurances. But yes, that would meet the definition.
Yeah, and I mean, I'll touch on that because me and James have a close friend who recently passed away from pancreatic cancer, and I was his advisor and close friend, and similar thing. Last start of 23, he calls me up, the day before he's meant to start, and I tell him off for working, and then he's like, actually, it's not a work call. Something serious is going on. I'm going through these tests, and he had pancreatic cancer, and so it started with a trauma payment, so a lump sum payment. So that trauma is just a once-off payment. And his policy had income protection, and within the contract of the policy, it automatically, on trauma definition, gives 6 months automatically. Oh. So even if he's not off work for 6 months, he's got that payment.
So you got the lump sum and the income protection?
Yeah. So he got that that 6 month payment as a once off payment.
Right.
Okay. And then after that 6 months, he wasn't working full time, and so he had to prove that he wasn't working. Very easy to prove when you got pancreatic cancer. Mm-hmm. But he was actually able to go back to work 1 day a week. He was motivated to go back to work 1 day a week, and that didn't impact his income protection payment. So within the contract, you could work up to 10 hours and still get your full income protection payment. So we got that for the next 6 months. And then he got a terminal diagnosis, and the doctor said, hey, we've got weeks to live and not months. And so obviously it was big news to him and heartbroken for myself, but putting my advisor hat on, we straight away said, okay, that's a terminal claim. So his life insurance can get paid out before he passes away. So we did the paperwork and helped him claim that terminal illness payment. So if you got a diagnosis where you're terminally ill and you're unlikely to live more than 12 or 24 months, you can get paid that life insurance. So you got that lump sum trauma, lump sum income protection, and then monthly payments for the next 6 months, and then that terminal illness payment. And for him, and it was super important for him to have that money in the bank, the debt paid off, to know his wife and his kids are going to be, they're not going to be okay, but they're going to be somewhat financially supported. Yeah.
Okay. So, and I'm assuming this fella, he wasn't that old when this happened.
No, 42 when he was diagnosed. 43 when he passed away.
Yeah. A friend of mine, I've remarked on the show before in finance, super fit couple. They realised that they had, I think it's about 80 grand to cover for life through default cover inside super, and they recently had a diagnosis. Fortunately, it wasn't nearly as bad as what we thought. It was similar type of thinking initially. And to be honest, they're financially already dealing with like the big consequence in life, but then financially they would have just to be honest, it would have decimated them. And there's kids involved, and it just really shook me up, to be honest. In terms of default cover, Phil, a lot of people, when they think, I've got Australian Super, there's insurance in there, I think.
Yeah.
Can you talk us through that? Like, a lot of people think, well, I've just signed up, I'm pretty sure there's cover in there, she'll be right.
Yeah. So, in Australia, we have the best economic situation in the world. We've got guaranteed, your employer needs to put money into super and for your retirement. And if you can't fund your retirement, the government, comes in. So we've got an amazing system. One of the things with superannuation is a super fund, the trustees need to consider insurance as well. So a lot of super funds will have insurance built into their super fund. So with Australian Super, because you mentioned them, their default level of cover at the absolute maximum, and it's always age-based. If you join when you're young, it's a bit less. As you get older, it tapers down as well. Mm-hmm. The absolute maximum, I think it's 35 years old, you get $181,000 of life cover. And then the absolute maximum of TPD is $61,000. And so your friend's experience is very similar to everyone who's relying on their super fund to fix it.
That's the biggest super fund in the country, isn't it?
Yeah, that's the biggest in the country. So, insuring millions of members. And so the maximum life insurance, $181,000. The average mortgage in Australia, I just Googled before, is over $600,000. Average income or the median income is just ticked over $100,000 for full-time workers. And so to think, if I was disabled and can never, ever, ever work again, the most my super fund will pay me out is $61,000 as a lump sum payment.
It's crazy.
And to cover that $100,000 that I've just lost. And if I pass away and I got debt and I got kids, maximum I'm getting is $181,000. So, it is very common. People think, my super fund's got it covered, I've got it sorted, or I set it up years ago and I should be okay because I haven't looked at the statements in a while. Most Australians are significantly underinsured.
I only learned recently that unless you go through the full underwriting process, this is a true or false for either of you. I only learned recently that unless you go through the full underwriting process, when you increase your cover inside super, let's say I pay it for 10 years, even though I've paid the thing for 10 years, at claim time, they might deny it because I didn't go through the full process. Is that correct?
Well, not really. Like Australian super, the super funds will have some, different super funds will have different contracts. Let's just put it out there. Some contracts will say any pre-existing conditions will pay out because guess what? We're only exposed to $61,000 for a TPD and $181,000 for life. So their exposure is always pretty minimal. So sometimes they won't factor in any pre-existing conditions.
So that's the default level.
Default.
But what about if I went I ratcheted it up to 500,000?
You would need to do medical questions.
Yep.
And so in those medical questions, if you did not accurately disclose your previous medical history, they may decline the claim. And so we have a lot of clients who $1 million of life and TPD, and then we look at their health disclosures they give to us, and we look, there's a mental health condition before you increase this cover, and we actually say, hey, can we go back to Australia Super, get your medical disclosures because you probably just did it on the couch, on your laptop, and you didn't really think about it. Go back and just double check you disclosed accurately. And more often than not, they didn't disclose accurate versus what we're seeing, and then that's a non-disclosure. So if they go and claim on TPD for mental health, the insurance company can then say, hey, which is TAO, who's the insurer for Australian Super, they may say, hey, this is a pre-existing condition. We've asked you this specific question and you lied to us. It may have been intentional or not. Doesn't matter. You didn't tell us the right disclosures. We're not going to pay out based on that.
Even though you've paid it, you don't know, you don't realise. And maybe it was innocent, maybe it was not. But I've got one more question on this, which is something that it probably deserves a whole other podcast for. But basically, you just talked about how even though people think it's Australian Super is the insurer, it's not. There's an actual insurance company behind the super fund. You've told me before that increasing the cover that you have inside super can actually be very costly. Can you talk through why that is the case?
Yeah, we'll go kind of large scale. So, Australian Super, every 3 to 5 years, they will tender that insurance contract because it's worth hundreds of millions of dollars. And so they'll go out to the market and say, hey, what's your price? And Tower will go in and say, hey, we want to, this is our terms and conditions. MetLife will come in, Zurich will come in, all the big insurers in Australia will come in, and they'll be the underlying insurer. And they tender on that default. So they'll say, we'll charge your members this, this calculation based on age, based on, all these factors. And so Australian Super look at that tender and they go, okay, we want to minimise premiums for our members. We want to make sure there's more super, money in the account. But they don't tender on that increase. So what insurance companies, they may not do, but when you look at the numbers and you just, put a calculator behind it, you look at the default cover is, very, very cheap. And then when you increase it, I wouldn't say gouge, but others may say that.
I would.
Yeah. They basically gouge on that increase.
Okay.
And so, we've done a lot of, stats internally in our business and just go, when you increase with the insurer, Tao, that's where they make their money back because they underprice that default cover.
So they win the job.
Yeah, they win the job by underpricing, and then the way they get it is 10% of all members will increase it, or 5%, and then so they need to be profitable because all insurance companies need to be profitable. So the old adage of, well, your super fund has insurance, just increase within your super fund is these days statistically very expensive.
Right. Okay. So that's where I am going to go through this process with you because I did increase it many years ago. And I've held that for a long time. So I think it's time for a reprice at the very least. James, before we hit record, you were talking about how there's this critical moment in someone or a couple's life where they're approaching retirement. And depending on their circumstances, they kind of like fall into this category where I don't have a name for it, but they fall into this category where it's like a rock and a hard place in some respects. I know you deal with a lot of people in their 40s, 50s, 60s, like that's bread and butter Northeast. Can you talk about what that situation is and why they end up there and some of the options?
Sure. Yeah. So what we were describing was the cruel irony that exists because insurance premiums become more expensive with age. For a number of reasons, but the simplest reason is that the older you are, statistically, the higher risk you are of developing injury or having an injury or illness. And so premiums, especially in your 50s, late 50s, 60s, they can become a really high proportion of either your income or your free cash flow or even your super balance, depending on your circumstance. And something that we find challenging, as do a lot of advisory practices, is when you're sitting with an individual or a couple that might be at that age where premiums are starting to hurt every year. The cruel irony is that if they were in a much stronger financial position, they wouldn't need the cover. So for example, often those people, they might need the cover because they still have the big mortgage or their super balance is really low because they've been self-employed for a long time and not made any contributions. And so their net assets are quite low. And if, for example, one of you were to pass right now, there is not enough money for the surviving spouse and the family to live comfortably. That's the purpose of insurance. The catch-22 is that means you need more insurance, and more insurance is even more erosive on your limited financial resources. So you have to be really functional when you get to this point. I don't like to be idealistic with insurance. I like to be quite functional about what do we need. We don't, certainly in my life, thinking about for my wife and I, Lou, if one of us is to pass, the other one isn't, in this lavish lifestyle immediately, because we want to try to keep our premiums down, and the long-term impact of trying to keep costs down is beneficial, right? But also, functionally, what do we need? We've got a 3 and a 6-year-old. We've got our own ideas as to what we want for them in terms of their growth and development and education, and then we've got a mortgage ourselves. All of those things have come together for us to decide what the right level of cover is for us. And what happens as we get to as you age, and you enter that 50s, 60s time frame, is that we have to keep resetting expectations. Instead of saying, well, ideally it would be nice for the surviving spouse to be able to clear the mortgage, and I wanted to leave a little bit of money to my son, and we have to say, look, that's all well and good, but these costs are too prohibitive. We need to dial this down and strip it back to be, ultimately to do less. We have to hope that, of course, it doesn't happen. Stay healthy, do all the right things. But insurance ultimately it's critical. We all know the value of it. We all have our home and our car insurance, but you're losing money with insurance. Insurers have to make a profit, and the extension of that is that every dollar you get in, you get a smaller amount back. It doesn't devalue it, but it's just a fact of doing it. So we want to have people losing as little as possible.
Right, but it would come to a point where you are getting riskier, and you're maybe like your budget, you're trying to plan for retirement, you've got competing interests like retirement, but pretty bloody costly insurance premiums.
Yeah. And we sit down with members sometimes and prospects, and we're modeling this and saying, okay, based on your earnings, in your likely earnings in your super fund, plus the contributions we're getting in, plus what we can manage to get in addition to that. And then after taking away this big whack every year that happens for insurance, whether in your own name or through super or a combination of the two, if you got rid of that, the trajectory is completely different, but we can't get rid of it because you need it. And so yes, it's definitely a thing.
And it comes down to a values discussion. It's all about values. Some people will value that policy because they can sleep better at night, or they need it, or they feel like they want that protection. And other people will just devalue it and just say, actually, you know what? Let's just be very mathematical about it. The likelihood of this happening is, yes, it's growing, but it's still relatively small. But the likelihood of having a retirement that we're comfortable in is becoming even more limited. And so it's just all about a values discussion about, really what do you value? And as advisors, our job is to facilitate that conversation, and just as much as we can not try and put our values into that. What we try and limit it as much as we can. I'll tell someone they're being an idiot if I think if they're like 35, high income, huge debt, kids, and they say, I actually don't value insurance, I don't need it. I'll be like, well, I think you're an idiot, but go for it. At the end of the day, you make your own decisions. So we do always put our values on there, but we try and just facilitate a conversation about what is important and what's not important.
But it could be pretty expensive, I'd imagine. Like once you get to that level, like 40s and 50s, I would assume, no, I'm not at this stage yet, but I would assume that some policies are in the tens of thousands.
Yeah. It's crazy expensive when you're a lot older. And again, it's just a values discussion.
We had a member come to us within the last 12 months who is a medical professional, and his combined insurance premiums were $240,000.
Oh my days.
And what made it more...
Wow,
he
that's
was,
the highest I've ever heard. Wow.
63 years old. What was more alarming is that when we went through it all and looked at his needs, in the end, we ascertained that he needed about a fifth of it. Now, I mean, you can get a sense for the financial situation of someone who can drop $240K a year on premiums. Like they're doing okay, but it was a lot of money being sent away for no purpose. And he came to us saying, look, what do I do? Because they're so expensive. We ran a needs analysis and we're like, wow, you need so little of this cover because your wealth has kept increasing and you've just kept the premiums as they are.
And the other thing to think about is for younger people, we look at, we've got premium projections on the policies and stuff. Young people look at it and go, well, if my premiums are going to be 15 grand in 20 years time, should I take out this policy? It's like, well, no, the need is there now. Let's take it out because the premiums aren't 15 grand today. And then as you get there, then it's a values discussion of let's tailor it down. You're paying off your mortgage, your kids are out of home, and all of these things means that actually the need isn't going to be there to mean that you're going to be paying those premiums at that age.
What about stepped versus level premiums? Some people talk about this. I don't know, can one of you define what that is? I'll just throw it to whoever.
Yeah, so there's two ways to pay your premiums. again, when you're setting up through a financial advisor, you got those options. Through the super fund, you don't. Direct, you don't. So step premiums is cheaper today. It's just based on your age. We'll price the risk on your age today. And so every year you get older, well, that risk increases, so the premiums will go up. Right. Yeah, it steps up. Level, which, the government or the ASIC are trying to change the name for level because it's not actually level, and I can touch on that, but it's much more expensive today. But the thing that won't increase is it won't increase based on you just simply getting older. So all things being equal, your level of cover being the same, the insurance company not repricing at all, it'll be exactly the same premiums year on year. So it can be sometimes significantly more expensive, but it means when you're in your 50s and 60s, you're not getting that age-based increase where it can be literally a 30% increase just because you're getting older and nothing else changing.
Right. And does that apply just to life insurance?
All the life insurance, categories. So life, TPD, income protection, and trauma. You can select one or the other.
Right. I know it's very hard to do this just on the fly, but I don't know, if there was just like a typical case, what is typical of a younger person? Because I'm thinking of, like, say, the 20-year-olds that listen to this and they've made it through 56 minutes of the podcast.
Well done.
Well done. Yeah, good on you. Or even the 30-year-olds that are like, this sounds interesting because maybe I can put myself in a situation where I've got one of these quote-unquote level things, and in 20 or 30 years, I'm benefiting from a decision I make today. Mm-hmm. So you're saying that they may pay more now, but in the 20-year case, they might pay less.
Yeah. So, so premiums can change for 3 reasons on stepped and 2 reasons for level. So one reason both of them will change is because your level of cover increases. So for income protection, you want to make sure your level of cover is increasing year on year, because in 20 years' time, your income today will be a joke.
Yep.
Hopefully. Yeah, hopefully. Well, just inflation will be.
Yep.
And so that'll always increase. You can always turn that off if you want to. So that's an optional increase. The other one is if insurance companies increase their premiums. We've all seen this when it comes to your car insurance, your home insurance. Every insurance policy over the last few years has the insurance company have come back and said, we're increasing the premiums. So that's the base premiums. Now that can happen for level and for stepped. And so some people think, well, I've paid more today and then they're also increasing. That can be unfair. It is, but it's the insurance premium. The insurance provider needs to be profitable, and so they make that decision. The only thing that's different between those two is that stepped is age-based increases and level won't be an age-based increase. So, we in our business, we do we've got like a big portion of our client base are very young. So we are big believers in level premiums because, I was talking about it earlier, a client who was 62 at the time, paying 24 grand in premiums for very kind of, modest levels of cover. And I'm like begging her to cancel or at least reduce because it's had a significant impact. And it was like 40% of her income. Like, oh, wow. I'm thinking, you're going to work for, 40% of your time is just to pay these premiums. And so, but for her, she made a values judgment to keep it, even though I put my values of please cancel this, as well as being, So I was begging her, but she didn't want to, and they were step premiums. And because every year, 30% increase at that age is significant. So we do a lot of level premiums for depending on the age of the client. Our house view is post 40. We like step premiums because as you get older, the differential at year one is much more significant. So, if you're 20, if you're 30 years old, the difference between stepped and level, it's still a bit, but it's not hugely cost prohibitive. But, when you're 50 years old, the difference between those two is significant.
Right. So earlier is better.
Yeah.
As a general rule. Okay. James, throw it back to you real quick. Some people get confused between work cover or like whatever the term is, work cover, and income protection.
Yeah, I'm not taking this one because you've got someone who's actually going through this right now, don't you, Phil?
Yeah, so, you asked the question before, can you get paid 2 income protections? It's similar with work cover. If you've got income protection and you're on work cover, they won't both pay out. Okay. So work cover is you've got to prove that the injury or illness happened at work. Anything outside of work, which is most of our time, any injury, illness outside won't be paid under your work cover. But income protection is for any illness, injury, sickness, health reason, assuming it's not excluded from the policy, you'll be paid out under the contract. And so, work cover, and so they do work together. Work cover, if your workplace, hasn't been safe and you're injured at work, then you can, your work cover can pay out. Now, work cover, there are a whole bunch of reasons, and it can be difficult to claim for a long period of time, even if you can prove that it was an injury there and it's a long-term injury. So that's why, you may just go, well, work cover is actually becoming too difficult to deal with after 2 years. Do I then utilize my income protection?
Okay. James, general question for you around, so obviously we've gone into the weeds on different types of insurance. People are aware that this is only one part of, say, what you do as a financial planner, or even anyone that's DIY in their own finances. We spoke about, someone passing before. What other things should people be considering? So I'm thinking about like wills, these types of things. What other things should people be considering?
Yeah, wills is a really important one. In our business, we have a number of different categories that we look at when we're assessing someone's finances, and this insurance falls under the banner of wealth protection. So certainly estate planning, wills is a really important part of this. We regularly meet with people that have both superannuation and also insurances whereby they've got levels of cover, whether or not, let's say for simplicity, that they're appropriate or appropriate enough, but where the money's actually going to go, or most likely to go, is not consistent with the reason why you're holding the cover. I spoke before about that example of someone who says, I really want $100,000 to go to my son if anything happens to me. Well, in that case, depending on how you structure the policy, you might want to stipulate that in the policy and ensure that the money gets directed where you want. People often forget that when you complete a will, which if you don't have one, please do. It's one of those things that you won't be around for it, but it will make a big difference, I promise you. And when people complete a will, they don't necessarily realize that your superannuation is not governed by the will. It's called a non-estate asset. And particularly if you have insurance within superannuation, we've already spoken to the benefits of having life insurance inside superannuation, and it can be pretty significant if you get it set up correctly. But one of the byproducts of that is that you might say, I want all of my assets to go to, through your will, I want all my assets to go to my partner or my children or whatever it would be. Your superannuation doesn't even, they don't follow that guidance at all. And there's a vehicle called a binding death benefit nomination or a death benefit nomination, and that is essentially, in simplicity, it's a will for your superannuation. So certainly having that covered is important.
Yeah, and insurance and super, they both don't form the asset if you've got a nomination. So that's why people may, if they're going through a separation or whatever life changes, you want to update it, they update the will by realizing that their nomination in their super fund and the insurance policy is still getting, pointing somewhere else. And the super fund and the insurance provider needs to follow those instructions.
So let me just unpack what you said there. I go into my super portal and I do one of these nominations, either a binding nomination or just a regular nomination. I say it's going to go to you, James, for whatever reason.
No, not for whatever reason. It should.
Yeah, it should. And then, so Phil, you're the insurer. I pass away. I've got my insurance balance, but I've also got a payment that's come in from my life that would go to James. Is that correct?
Yeah. Let's just say yes.
Well done, James.
Yeah, well, do you actually have that right now? Or?
Yeah.
What do you think?
So then if you want to change your will and your will says give me everything, your super fund will still point it to James, even if you want to give it to me.
So I'd have to update both the
Correct.
will and the nomination.
So with your super fund and your insurance policy, you can choose to nominate it to go to the will. There's pros and cons for why you should or shouldn't do that. So the pro is that, well, you just update your will. That's easy. The bad thing is, and with doing that, is if anyone's gone through an estate, it takes time to get the money released. You got to go through probate. With super funds and insurance proceeds, they can go directly to who you want without going through probate. So as soon as you provide a death certificate, the money gets released.
So in that instance before, if I died, you could effectively, as the insurer in this instance, you could effectively pay the money straight to James, and even though the rest of the money for the estate, so to speak, is going to be sorted out, insurance money is sent separately.
Straight
I'd
away,
be in Borneo in a matter of days.
Yeah. Tahiti.
There's another thing to consider too, which is, for example, if you have separations and people where your estate might be a little bit unique on what you want. Because superannuation is not governed by the will, and it's what we call a non-estate asset, you making a binding nomination to me, for example, is for the most part incontestable.
Yeah, your wife can't say, well, that's stupid.
Why did you give it to this James guy?
Yeah, who is this James guy, number one? And why did you do that?
What was your relationship? Yeah.
And so that is really meaningful for some people. Like you might, for example, you might have a marital separation and I really want this money to go to my kids, but for whatever reason in my family, I am a little bit fearful that if I were to pass, that someone in my family would try to get their claws on this. And there's, we get deep into really family law at this point, or estate law, but the benefit of a binding nomination can mean that for my super and any insurance held in my super, if it's set up correctly, at least I know for sure that money is going to go to where I want. So, as close to for sure as we can. It's incredibly rare to contest those successfully.
Yeah, and all of these things definitely get advice on it all, because it's very, there's different tax considerations and a whole bunch of things to consider.
Yeah, I don't think Finder has any boxes like this.
No offense, Finder. They did send me a little...
I saw that on your desk.
Yeah, a little toy the other day. It was meant to be me.
Oh.
Anyway, that's the whole thing.
That's nice.
So I guess one thing we didn't talk about, and I just want to nip this in the bud, is on income protection, is a lot of people know that you can set different, I guess, terms for it. So you could go, say, to 65, you could go for 2 years or 5 years, and you can set the duration that you will be paid that income. Can you explain maybe how that impacts, I guess, the amount that you pay?
Yeah, so I mean, there's heaps to consider in regards to premiums, like your health history, your occupation, all of those things are big considerations, which you can't change. The things that you can change are really three things. So the level of cover. Do you want the maximum you can get, which is 70% of your income, or do you want a little bit less? The next thing you can consider is the waiting period. So that's kind of like car insurance excess. So if you are injured, you need to wait a specific amount of time, either 30 days, some insurers do 60 days, 90 days, and you can be up to 2 years waiting period. So you wait that length of time. If you're still injured past that waiting period, then you're eligible for claim.
Yep.
And then the next one is the benefit period. So how long, if you're on claim, will you get paid for? So there's really three main ones: 2 years, 5 years, until age 65. So what that means is if I'm on claim and can never work again and I get paid for 2 years, but my policy is only a 2-year benefit period, then my income stops. Doesn't matter what my health situation is. And again, same for for a 5-year benefit period, it'll pay for 5 years. Same for till age 65. And they're all considerations when it comes to cost. So, if the premiums are too expensive on a 30-day waiting period, can you think about, over the next 12 months, we save up more to extend that 90-day waiting period, because that'll save you premiums. Is an age 65 appropriate? Now, if you're, like most of our clients, they're 35 years old, they're going to, if they claim they're on claim for 30 years, well, that's really important to have an age 65 benefit period. But if you're 50, 55, and you're actually, getting very close to being financially, independent, well, maybe you only need a 5-year benefit period or even a 2-year benefit period, because you only really rely on that income for the next 2 years, because then if you couldn't work, you're financially stable still.
Makes sense. So this is where I was going to then throw it to you, James, is people are saying, you can maybe lower the cost by choosing the appropriate mix of that. I'd assume that people that can save money, you would suggest having that emergency fund and setting that up in a way that you can effectively, quote unquote, self-insure for little things in the meantime.
Absolutely. Yeah. And it speaks back to that cruel irony of insurance, which is that you have someone who comes in that is mortgaged to the hilt, has credit card debt, very little free cash flow month to month, and you can see all of that. That person might need a 30-day wait, or maybe even a 14-day wait on their income protection policy, which would send the premiums through the roof. If that person alternatively had, I don't want to say this flippantly like it's an easy thing to have, but if you had 3 months of expenses in the bank account, well, then we're going to change the waiting period, hopefully to at least 90 days, say we'll self-insure for that period. Those premiums are going to come down a lot as a result of that. So yeah, without a doubt.
So it's like that safety blanket that gets you to the point of when you would.
Well, that's right. And back to this values discussion, as a financial advisor, we had a client who said they want 14 days, and literally 14 day to 30 days. And you can't really get a 14-day waiting period these days, but it was literally double the cost. And I'm sitting here going, can you please just wait? And I was like, can we not borrow money off family or friends? Like, this is really expensive. And they were self-employed, physio, and said, hey, if I cannot work, 14 days is too long.
Yep.
And I was like, okay, me, pragmatic, I'm a tight ass. So I'm like, please, let's bring these premiums down. But it was super important for her. And I was like, great. But next, save. And then so we can just extend this waiting period.
So start with this
possible.
and then sell that extra iPad you don't need. Put that in the bank account kind of thing. Yeah. Okay, great. So I think we've gone pretty deep on a lot of these important topics. What I would like to do now, just as we kind of wrap up a little bit, is just to prompt everyone that's watching or listening to this around some things that they can actually do, because we've covered a lot of ground. So we've covered over an hour of insurance, a little bit of estate planning, a little bit of cash flow there towards the end. The key message from this entire episode is really that there is a big world of insurance out there and you do need it. Most likely, if you're a working age person, you've got kids, business, you've got a mortgage, you've got kids going through school, or friends or relatives that you care for, get expert advice. That is probably my big takeaway. And there is a link below the video where you can learn more about both James's business and Phil's business, and you can get in contact with their team. I highly, highly encourage you to do that. That's exactly what I'm going to be doing as a result of learning more about this. And to be honest, some of the things that I learned when I was studying financial planning, I think have changed since going more into this and realizing how the industry has shifted just in a few years. So Phil, maybe I'll throw it to you first. As a takeaway for anyone that is listening or watching, what would you leave people with?
Yeah, for me, I just think about awareness. Like, if we just ignore something, then it's still going to be there. So look at your super fund and see what you've got today. If you're with Australian Super and you're on the default level, $181,000 for life insurance at the high end. So just being aware of what you've got. And then the other thing is, what will you actually need? Now, we've got our own internal formula. We geek out a little bit over the numbers, but just think about it simplistically. What's your income? What's your debt? Do you have kids? Do you have, responsibilities? And is that level of cover you've got through your super fund, or if you set it up externally, do you believe that to be enough for you? And for most Australians, it's probably not, because we do rely on that super fund to cover us. And it's often lacking and actually been decreasing quite a lot recently. So for me, it's just about get aware of what you've got today, and if you believe that to be enough. And if you don't, then definitely reach out to an advisor to help.
Mm-hmm. James, same question to you. Is covered a lot of ground. What would you leave people with?
Yeah, firstly, if you're this deep in, hats off to you. Look, it's not out of the realms of the possibility that the only person left is my mum at this point. So, hi, Mum. This is an area of advice that really does you really will benefit from engaging with an advisor. And of course, there's a huge amount of self-interest in me saying that. But candidly, if you have the need for just insurance advice, as I said at the beginning of the call, I think you'd be best placed to go to Phil. Go and sit down and reach out to his team and have that discussion, because they're best in class in this area. So hopefully you can see there's an element of altruism with what I'm saying here. It is worthy of getting advice. You can do it yourself. You're not going to save a huge amount of money. In most cases, I would assert that you're probably going to cost yourself a lot of money over the long term. And I'm sorry to say, you're likely to cost yourself a huge amount of money on a comparative basis if you do make a claim, because an advisor will really get that bit right. Phil talked earlier about the fact that this is pretty well subsidized through the fact that there is a commission paid back. Just like when you go and see a mortgage broker, for example, you don't lament the cost of seeing a mortgage broker because it's predominantly paid for in a commission. So absolutely awareness, but then also if you identify that there's that gap, which respectfully you're probably quite likely to do, take some action. It's it's less work than you think it might be as a project, especially if you've got someone in your corner to help you. And, once you've got it set up, then it's far more iterative. So take some action to get it done.
Yeah, no matter who you are, even if you're on extremely high income, you've got a big superannuation balance, you're later in life, you're early in life, doesn't really matter. Should reach out and just explore the topic anyway. You may as well engage an expert from the get-go, especially for something like this. Like, it's always like the old Charlie Munger adage is, tell me where I'm going to die and I won't go there. This is something where this is material to people's finances. This could completely ruin them and their family if they don't get it right. And I think that's why this was worthy of a very long episode. And I hope that the majority of the community can listen to this, whether they're business owners, whether they're investing in property, whether they're just getting started on that journey. It does not matter where you are. Go and get this type of advice because it is so essential. That's what I'll be doing. And I think, you've heard it from the financial advisors. They do it. So if it's good enough for them, it's probably good enough for the rest of us. And there are no barriers to entry here. So check out all the links in the show notes. If you want us to do more, or maybe you want us to answer questions, please write into us. There is also a link in the show notes there. We just love that because we want to know that you're actually taking steps. Give us your feedback. Let us know what you think and how you approached it. It'd be great. So Phil, first time on the show, first time on the Rask Network, in fact. It's been an absolute pleasure. You're a natural, mate. Thanks for joining us.
Yeah, thanks for having me.
And James, always a pleasure, mate. And in the full kit, like me and Phil, repping it Northeast. Thanks so much.
You're welcome. Pleasure. Thanks, everyone. Hi, Mum.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.